to give you a little background, Civitas Strategies, we are a nationwide organization that works with childcare providers. Right now, we're working with childcare providers in 12 states. So it is our goal to help you grow and strengthen your businesses. So we do appreciate you being here with us this evening. All right. So we're going to cover some very, very important topics surrounding taxes this evening. It's going to help you run your childcare business smoothly, not just during tax season, but also year round. So the things we'll talk about tonight will definitely help you outside of tax season. So that's fantastic. So what are we going to discuss this evening? Today, we're going to discuss why you should care about your taxes, not just on April 15th, but let's talk about why you do need to care about your taxes throughout the year. So we're going to talk about some things that will help you with your business in general throughout the year, but also not just waiting until April 15th to talk about your taxes. So next, what we'll do is we'll explain what a Schedule C is and how you use it to report your childcare business's income and expenses. So we know as family childcare providers, the Schedule C is how you file your business use of home taxes as well as all of your expenses. So this is a great time to be taking a look at that before you jump into preparing your taxes. We're also going to go over the steps to get organized and prepare for tax filing. So those, again, steps you could use throughout the year. And then I've got a little tip here about how you could mitigate your taxes from last year. There's actually something that you can do this year still do to affect your taxes in your 2023 taxes. So that's something that's exciting that we can share. And the goal today is to provide you with tax knowledge to optimize your filing, minimize headaches when tax season rolls around again, right? So everything that you learn today, you're going to be able to take into the future and you'll use it in future tax seasons. So once again, great time for you to have joined the presentation. All right, so knowing how to effectively address your taxes can help you with several different areas, and this is why we should care. So the first is profit retention. So it's the responsibility of every business to pay their fair share of taxes, right? But proper tax preparation can be a vehicle to help you recapture hard-earned profit and keep more money in your pocket. But understanding allowable expenses does legitimately result in paying less taxes and retaining profits. So what we're really stressing, right, are that legitimate expenses and deductions help you keep more money. That doesn't mean that we're going to look for expenses that are not legitimate, right? And we'll keep that in mind as we go through. Everything that you're going to be doing will always be something that is allowed under IRS law. So we'll be taking a look at that. Now, another reason to care about your taxes is risk mitigation. All right, so education is key when it comes to understanding allowable expenses and properly preparing your taxes. So the more that you're aware of tax rules as they apply to childcare businesses, because some things are different for childcare businesses, the less likely you are to trigger an audit. So audits can be very time consuming, they can cause distress, and at the end, they usually prove to be very, very expensive, very costly, often causing you to have to owe money that you perhaps may not be prepared to pay. So we want to avoid audits at all costs on there. Another great part of tax time and preparing for your taxes is that it helps you understand your business's health. So it's a fantastic way to evaluate the health of the business because you'll have an accurate account of your profit, and it really allows you to understand the financial position that your business is in. It can help you plan for changes going into the future. So that understanding of your business's health is truly invaluable. So that is it's a great time to do this, to figure that out, and then learn to do it throughout the course of the year. So absolutely. And build business confidence, right? So knowledge is key. Having the confidence in knowing that you have properly claimed deductions and that you've met your tax obligation removes a factor of the unknown, right? So if we think back to, we want to mitigate risk, we want to avoid audit. Well, once we know that we've properly prepared our taxes and that's where what we're achieving, business confidence then, right? We've got confidence that we're doing the right thing. When we understood our business's health, we realized exactly where we were, certainly able to plan better, having that awareness. All of that leads to business confidence. And understanding taxes does give you the understanding to continue to operate in the mindset that you are following the rules of the IRS and you are unlikely to have any unforeseen debt or potential future problems. So really good, all good reasons, right, to care about your taxes. All right. Well, we have something interesting here. So we've done some research on home child care provider taxes, and it's illuminated several findings. So we work with child care providers every day, and we happen to work with some where we evaluated their taxes, found out some very disconcerting information. So of the people that we were able to review their taxes, 83% of home-based child care providers did not claim the business use of their home at all. Well, the IRS allows for those deductions on your Schedule C, line 30. It's right there, business use of home. And you can take any of the deductions associated with that cost. But we found 83% of the providers that we spoke with did not claim those expenses. Now, in some cases, seems hard to believe, right? But providers did not claim any expenses at all. It should never happen. Every dollar is important to reinvest in your child care program. And undoubtedly, anyone operating a child care business has deductible expenses. There are expenses that you have to have, right, when you operate a business. So there should never be a situation where a business is unable to find or claim expenses that are associated with their child care business. When we go over the Schedule C, you're going to see that they have IRS has many different categories under which all of the deductions can fall. And we encourage you to review each category to identify qualifying expenses so that you can lower your tax liability. Now, the other thing that we found, and we did talk about this, right, in mitigating risk, is that many providers were claiming invalid expenses, and that's going to drastically increase their chance of having an expensive or time-consuming IRS audit. So obviously, we advocate claiming all valid expenses with the keyword being valid. So perhaps you have expenses that are not valid for your child care business, and those are not going to be included on your taxes. There are some expenses that you may feel that you're entitled to that you include that could automatically trigger an IRS audit, raises a red flag. Those are things that the IRS looks for when they're determining who would be audited there. So just keep this definition in mind that as a rule of thumb, the IRS considers a valid deduction to be ordinary and necessary required for operating your business. Ordinary and necessary required for operating your business. So what the IRS does is they evaluate expenses to see, are they appropriate based on your business type, right? So when they look at your tax return, they take the type of business that you have into account, and then they look at those expenses, and do those expenses align with legitimate expenses for that type of business? So that's kind of how that works with the IRS. And then something else that we found was that several common deductions were either miscategorized or improperly calculated. And when that happens, it can, again, raise an automatic audit alert, even if the deduction is valid, right? So if the deduction is in the wrong place, it can raise a red flag. An example that we found would be deductions for children's meals. So it's found that many childcare providers were basically deducting children's meals from the line on the Schedule C that is for deductible meals. But the IRS expects that line to be used for anyone providing that incurred business expenses for meals while traveling, going to meetings, going to continuing education, things of that nature. That's not where the cost of children's meals go. And if you have and children's meals, right? We know the cost of food, your food expense is going to be quite a high expense for you. It's going to be one of your highest. And seeing a high expense in the wrong category, again, could prompt an audit, even if unintentional. You're allowed to take those food costs. They just have to show up on your taxes in the correct place. So keep that in mind. All right, well, we do know with taxes, right, can sometimes get a little complicating. There are a number of different tax forms. Now, income for a sole proprietorship is reported on the Schedule C form, and that's part of your personal 1040 tax return. So if you have more than one business and they're not closely related in nature, you actually will have more than one Schedule C with your 1040. So an example would be is if you had a craft business on Etsy, and then you also drive for Uber or Lyft, those are going to be two different Schedule Cs. You'll have one for your childcare, you'll have one for your Etsy shop, you'll have one for your side business of driving. So just keep in mind, if you do have multiple businesses, you would be filling out multiple Schedule Cs unless they were very closely related. So Schedule C is easy. It shouldn't be intimidating. On the first part, you report your revenue, all of the money that you receive for your business. Then you show all of your expenses, right? So that those are the things that you paid to keep your business running smoothly. And then you calculate the amount that remains. So if it's positive, you've made a profit. And if it's negative, you had a loss, right? So the Schedule C should not be overwhelming. We're going to look at one next and get a good idea of what that looks like. All right, so what we're going to do is let's take a little bit of a closer look here because the Schedule C does have different sections for reporting data on your business, right? As we discussed, income, expenses, and then where we calculate either profit or loss on there. If you use tax software aligns with the Schedule C, and as you answer certain questions, the tax software knows where to put those. But everyone, even if you're not preparing your own taxes, should be very familiar with the Schedule C because knowledge is power, right? So what we want to be able to do is to understand how the Schedule C works, where things go. Again, even if you're going to a tax preparer, you are the best indicator of the health of your business. Therefore, you're the one that's bringing that information to the tax preparer, and you should know where it's going to go and what it looks like. So part one is where your sales are totaled and your cost of goods are reported. That way, once we have all of that, you see your gross profit, right? So I'll just kind of jump in, just mention this early. There is a line there for cost of goods sold, and often that is not something that is used by childcare providers. You'll most likely hear me mention that a little later there. But part one, where all of the sales, all the revenue that you took in is reported. Then part two, what we have here in green, is where all of the expenses are reported. So keep in mind that with childcare businesses, there are over a dozen categories listed here to help you stay organized. They could be advertising, car and truck expenses, legal and professional services, rent, travel, the travel meal expenses, travel expenses, and other costs. And then down there on the bottom, this is where you calculate your net profit, and that's on line 31, right? So what we're going to do is we're going to subtract our total expenses that we came up with in part two, and we're going to subtract those from the revenue that we came up in part one, and the net profit is, as a sole proprietorship, is considered to be your income from self-employment. So that number that shows up on line 31 is the income that you're claiming for your business. So that is something that will register throughout any business transactions that you do throughout the year that involve loans and things of that nature. They'd be looking at that number on line 31 as to what your business, your income is from self-employment. That's where you pay your self-employment tax. That's what's going to be on your 1040. So that's line 31, right? Pretty important in the tax process. All right, so now that we've looked at the Schedule C, we're going to switch gears for a minute, and now we're going to discuss how you can proactively prepare for tax season. This will help you avoid headaches down the road. Proper preparation, key to helping you tackle tax time like a pro, right? So let's do the preparation exactly as it needs to be. We'll be prepared. Everything, again, what does that do? Builds confidence, and you'll know that your taxes are being prepared properly and that you've covered all the bases. All right. Well, here on this cover, and Jill, if we do happen to have an error with this, please, by all means, let us know. But this is the Homegrown Preparing for Tax Season, a guide for home-based child care providers. So this is, in my opinion, one of the most thorough and important reference material that a home child care provider could have, but it also has a lot of things that centers can benefit from as well. So the whole idea is that this guide aims to help home-based child care providers optimize their tax preparation, that whole process, and maximize deductions. There are some amazing key topics included here. Homegrown has done a beautiful job with this information. They happen to work with us at Civitas Strategies to put that together. So what topics does that cover? Well, it's got record keeping best practices. That shows you how to implement tracking income, your expenses, mileage, business use of your home, right? Huge for home child care providers. Helps you to understand the Schedule C. So some of what we talked about today in the previous slide, it goes into even more detail on there. And it will show where you capture all the different kinds of expenses. It discusses how the business use of home deduction works, which helps you calculate and document time space, right? Very, very important. We're going to go into that in a little more in depth in the future. Maximizing write-offs with eligible deductions for supplies, meals, utilities, repairs, insurance, and more. If you ever wanted to see a list of allowable expenses for child care businesses, this is the place to go. So just keep that in mind. It actually has something that will help us track and claim automobile mileage for business travel. A lot of business professionals do use mileage apps, but this also happens to have a tool there that can help you with that. There's a section on depreciation, and a lot of folks have some hesitation about depreciation. So within the guide, it talks about depreciating assets such as equipment and furnishings over time, as you must, in accordance with IRS laws. It helps you take advantage of any type of pass-through deduction, qualified business income pass-through deduction. It helps you choose the right business structure. So often child care providers ask us at Civitas Strategies questions about business formation. This has information in there, for instance, LLC versus sole proprietorship. So if you're a sole proprietor and you're thinking of taking your business to the next level, this guide actually discusses things having to do with business formation. And it then has all of the proactive tax steps that you can take in the year to maximize next year's return. So there's a lot of information there. There are checklists, guides, visual examples, walks you through every step to help provide a home-based childcare provider with what they need to prepare for tax season. There are actionable steps that you can take. Open up the guide, you can get to work right away there. Really can help you make tax times that's hard to say, make tax time easier and save money. So that is without a doubt incredibly important there. And this 2023 edition has just been posted within the last week. Jill, real quick, do we have the correct link in there, or are we going to ask folks to hold off for a second?
That is the correct link. We're good to go.
Perfect. Thank you. So the link that is in the chat, as well as the QR code, you can use that to access this free resource, right? So to access the Homegrown Tax Guide, without a doubt. Again, one of my favorites. All right. So when we start to think about taxes, when it comes to understanding them, it's all about what you made and what you spent, right? All that revenue and all of those expenses. So let's take a little bit of a deep look into this, right? So as we mentioned on your Schedule C, first section is all about revenue. So how much money you made. If you have an accounting system, getting that information together is easy. But if not, don't worry. There's actually a revenue worksheet. There should be a link in the chat for that. There's a revenue worksheet that is basically within the Homegrown Guide, but there's a link to take you to a live worksheet that you can fill out. So if you don't have any type of accounting system, there is this worksheet that will help you as you go forward. Well, there's a quick picture of it in the next slide there. So what are we going to do first for our revenue? We're going to gather all of our records. So you're likely to have 3 types of records for revenue. First, 1099 forms. So that's evidence that another business paid you for your services, right? So many home care child providers will receive a 1099 NEC, and that's for subsidy care program payments and also for participation in the child and adult food care program, right? So you receive those 1099 NECs. You'll receive a 1099K often regarding expenses that may surround certain apps and things like that. I will bring to your attention that we had heard all throughout 2023 that whenever we received a payment of $600 or more through an app like Square, PayPal, Venmo, that we were going to receive a 1099. The IRS has changed that rule for 2023. There's a different rule there, so you are not going to be receiving them for the $600. It'll be a much higher threshold, and then that will change again in 2024 and in 2025. So just be aware if you were expecting a 1099, you may not be receiving it, and that's because in November that tax law changed. They made a change there. Now, another type of record that you would have to document your revenue would be bank records, right? So that will show any additional funds that you received from other sources. So you'll always want to go back to your bank records. And then you have your own documents, right? Which could be receipts that you have that show that parents paid for care, right? It could, whatever your billing cycle is, you have receipts from when you gave them a receipt and you have a copy of the receipt of when they paid for care. You want to take into consideration that you really need a nice method to also track cash transactions, because that is obviously revenue that must be reported. So think about all those sources. So as we're thinking about tax time and we're getting ready to file our 2023 taxes, we're going to put on that thinking cap and where is all of that revenue? Where did it come from? What documentation do I have? Let's make sure I don't forget any type of revenue that I need to document. All right, so here we have the revenue worksheet that we talked about. So this is from the Homegrown Workbook, happens to be on page 7. There will be the link in the chat that takes you directly to this, but if you use that link for the Homegrown Guide, you will be able to see the revenue worksheet in person there. So there's a place here, right, where we're going to include every 1099 that we received. We're going to list any income, such as grants, anything that isn't accounted for on the 1099. If you receive reimbursements through the Child and Adult Care Food Program, you will put all of those reimbursements in part 1 of the Schedule C using that 1099 that you received, right? That's why it's so important to collect the 1099. And what you have to think of is, okay, oh wow, I received that as revenue and now I'm putting that on my taxes. But remember, you're then going to be able to deduct those food expenses in full on the expense section. So you shouldn't get concerned that, oh, I have to claim that as revenue, because you're going to be taking those as expenses. So you just want to remember that that gets offset, right? So that's not anything to really be concerned all that much about. All right, so now we have our revenue set up. Now, what we're going to do is collect all of the expenses, right? So this is what you spent your money on in 2023. You want to have records of all your costs, ideally receipts showing payment for expenses, but you can also in most cases find canceled checks, invoices, credit card statements, bank records. So there is a lot of information that needs to be on a receipt or included with any type of report or anything that you have, should the IRS ever ask you about an expense. So what that is that you need to have that you paid the expense. So it needs to show that it's been paid, the amount that you paid, the date that you paid it, and a description of the item purchased or the service received. So just keep that in mind, that's the proper documentation for any receipt of anything that you have paid. You really do want to have that information on receipts. In the guide on page 27, there's a mileage log. There's a Google link there, a Google Sheet link, I should say, and that can help you if you don't have an app or another method of tracking mileage, because mileage is an expense. That way you can go ahead and you can determine the expense that you had for the use of your vehicle. All right. So we're going to get all of those expenses together, right? Go month by month through your records. Look for those credit card bills. Did you have any payment outgoing that was through Zelle, PayPal, Venmo, Square, anything that you had that you paid out? You'll do that. You'll look at your bank statements. You'll look at your checks, right? So once you've gotten all those expenses accumulated, now you could go, if you're going to use the homegrown guide, there's the digital expense worksheet. That's on page 10. There's a link on page 10, and that will take you to the Google Sheet. The worksheet uses the expense categories for the Schedule C that are most relevant to home child care businesses. So, but the nice thing about this is when you look at that expense list, it's actually something that any child care business could use. So any corporation, any childcare corporate or partnership, those expenses are also included on those types of tax returns. So this is not just for home-based childcare providers. It's a great reference. It's a great trigger to remember the expenses that you are allowed to take regardless of the type of childcare business that you have there. So keep in mind, right, that the full amount of home expenses that are directly related to your business can be included in your expenses on the table here. The IRS defines a direct expense as one that is incurred exclusively for the business and provides no personal benefit. So you do have expenses that are 100% business expenses and do not involve business use of home. So an example, what is an example of a direct expense that is entirely business only use? That could be if you were fixing a bathroom that's only used by the children, right? There's no home family shared use of that. If you had a playground equipment that are only being used by the children, that is a fully deductible 100% expense. Now, the other types of expenses that you have if you're a home family child care provider are those that are associated with your home, that are shared by home use, family use, personal use, and business, right? So something like that would be your homeowner's insurance, your electric costs, your utilities. We're going to talk about that as we come up about how we're going to calculate those expenses that are shared between home and business. We'll go over that in just a little bit, but what you'll want to do is you'll want to make sure that you keep all of the documentation that you need for at least 4 years. Now, what's nice, a good idea is perhaps to just snap pictures of some of those receipts of all of those documents and just put them in a folder on your phone, scan them to your computer, keep the paper copies as well. And that's just good record keeping system practice to have double copies of your receipts and make sure that all of those documents are safe and easily accessible. All right, so when we talked in the very beginning, right, we talked about mitigating risk and we said, hey, there are some things that could cause a red flag to be raised with the IRS. Well, sometimes it's the topics that you see here: vehicle, food, home, and then there's some concern around stimulus funding. So let's go look at these. They're considered to be tricky topics. So let's take a look and see. All right, so one of the trickier topics is transportation. All right, so as with all deductions, right, with the IRS, there are some very specific rules and guidelines that you want to follow. So these are all of the elements that you need to make sure that your transportation is deductible. So you're going to want to think about the list that you see here on the screen. Expenses relating to your vehicles must be in the regular course of doing business and directly relate to your child care business. So picking up the kids, that is a direct expense, right? That is a business expense. If you're going to Costco for your business supplies, for your food and things of that nature, that is business related. Now, one thing you want to keep in mind with anything having to do with expenses, vehicle and transportation expenses, is that you're going to keep your personal and your business travel separate. So as we keep records, we're going to be very aware that we cannot intermesh those two. All right, So how do we determine what a business trip is? So when it comes to business trips, the primary rule is that a trip can be used for both personal and business purposes, but it's only deductible if the primary purpose of the trip was for business. So I want you to keep that in mind. So yes, you can claim a business trip if you happen to have a little something that wasn't business, but the primary use of that trip, the reason for that trip, has to be business. So what's an example? It would be, let's say if you go to Costco, you've got a long list of supplies for the child care center, but then you pick up a jar of pickles for the family. All right, well, that trip is deductible because the primary reason for that trip was business, right? We were supplying our business with this long list of supplies. Getting that jar of pickles doesn't make that any less of a business trip, so that would be allowable. But if you went to the grocery store for your own groceries and then you happen to pick up an item for your childcare center or your home-based childcare business, that's not a deductible trip because your personal errands were the primary reason that you took that trip. So when we think about transportation, the key here is seeing, was the trip necessary in the first place for the business? If the main purpose is business, it's deductible, even if a few little personal items were picked up along the way there. But if the priority was personal and you just had a little incidental business expense, then it does not qualify as a deductible business expense. So just stop and think about those circumstances. And remember, as you're tracking things, you're going to be keeping those two separate. We're going to be very aware of our personal use of our vehicle and our business use of our vehicle. So, but now, if you are using a vehicle to conduct any type of business for your child care, you're probably wondering, how do I deduct those costs? I have legitimate business use of my vehicle. Now, how do I take those expenses? So there's two ways that you can claim the deduction, that you calculate the deduction and have an allowable expense. One is called the standard mileage method, and one is called the actual expense method. So we're going to look at actual expense first. All right, so actual expense, what is that? It captures all of the costs associated with your vehicle, but it does require extensive documentation because you're going to keep every single receipt that relates to your vehicle, and you're going to be logging mileage, but you log mileage not just for business, but also for personal. So the pro of using the actual method is that it may result in a higher deduction. So it may be a higher expense that you can take off of your taxes, especially if your vehicle is used exclusively for work, right? There's an awful lot going on that could be expensed. But a con is that documentation can take a really significant amount of time, right? So you're getting ready to collect and retain all of these receipts. You've got to keep a mileage log, keeping the business and the personal. You have to show both business and personal separate. There's a lot going on, right? So the actual expense method could give you a larger write-off. There's no doubt about that, but it does demand really careful record keeping. And again, we've got to track both business and personal use and proof of payment for all costs. So there is definitely a amount of documentation that in some instances could be overwhelming. Now, alternatively, if you choose not to track actual expenses, this method, which is called the standard mileage method using the IRS standard mileage rate, simplifies deductions. You don't have as much documentation that's needed. You still need to keep a log of business miles driven. So we talked about in the Homegrown Guide, there's a mileage log. There also are many, many different apps for your phone, not difficult to use, not that expensive. You should definitely look at different apps and see, what's reasonably priced for your business. So what's a pro of the mileage? Pro of the mileage is that there are less, calculation is easier, and there are less documents and records to have to collect. So just keep that in mind, right? You only need to track the business miles. You don't need to track the personal miles like you did in the actual expense method. But the cons are that the deduction is limited to a fixed rate by the IRS. Your records may get greater scrutiny. So that seems a little odd, right? But you just have to know that you're sticking with the mileage rate. So if we take a look on this slide here, just so you know, this was dated for 2022. It's actually in 2023, it's 65.5 cents per the mile. It will change again in 2024. So what you're going to want to do is always be checking the IRS website, looking to see what the standard mileage rate is for the year in which you're claiming the expense, right? So just be aware that that number does change from year to year, but that's a pretty simple way of having to track an expense. Now, keep in mind that either method, so actual or standard mileage, you still need to keep a log that shows the date, the distance traveled, the locations that you were traveling to and from, and the purpose for the trip, right? So we want to show that in the standard mileage that we are, that this is business use. When it comes to actual, we've got to show both business and personal. So standard mileage reduces the documentation burden, but you still have to carefully track the mileage, right? So, and make sure that you have those details for each trip. So what we suggest is that you compare the effort based on the use of your vehicle, compare the effort for each method. I would like to mention that you cannot jump back and forth between methods. This is not something where one year we're going to do the standard mileage rate and the next year we're going to do actual. Pick a method, stick with it. So basically, you're going to want to find something that works for you in the long run. And by comparing, looking at the two and deciding which of the best works for the amount of business use of your vehicle that you have, that's how you'll determine what method you're going to use. All right. So another tricky expense often are deductions for food and meals. All right. So food is usually fully deductible, but there's two exceptions. So the big question when it comes to food is how do I actually document the food costs? But if we think back, what are the two exceptions to not being able to claim the 100% of the food expense? Well, the first, children in your care rate are always going to be fully deductible. You can report those costs in different ways. We'll talk about those two methods. If you are doing meals for your staff, only 50% of the cost of that meal is deductible. And if you're if you're feeding your own children, those costs are not deductible. So those are the two times that food costs are not 100% deductible. Now, how can we deduct that cost, right? So now we know what's allowable. How are we going to go about deducting it? So there's two methods that you can use. One is the actual expense and one is the standard meal rate. So let's take a look here. All right. So you can deduct 100 as a business expense. You can deduct 100% of the actual cost of food consumed by your daycare. Only 50% of the, in general, of the cost of food consumed by your employees. If you happen to have a party or something of that nature for you, your employees, you actually could deduct 100% of the cost of that. But we're talking about your daily meals, right? So there are benefits that you can give employees that are basically if it's considered to be what's called a de minimis fringe benefit. In that case, the value would be excluded from their wages. It is something in terms of those parties that you can use there. Just keep in mind that something such as a party, right, is a benefit that you can have for an employee that is not the same as a meal. So as a standard day-to-day meal. All right, so there are the standard meal rate. Basically, what we can do here is with the standard rate, you're basically going to keep track of all of the meals based on the child and adult care food program costs. So this is a simplification of food expenses. Now, when we talked about the actual expense and keeping track of everything, there's a large amount of burden of documentation when you're doing the actual expense and you're tracking so much information. You are tracking the name of the child, the dates, the meals. There's a lot when it goes into actual expenses. And actual expense is the only way that a child care center can expense food. However, home family providers could use the actual method, or they could use what's called the standard rate. So this is something that makes it a little easier, right? So this standard rate can be used in computing the deductible cost of food for eligible children in daycare in lieu of actual costs. So you actually have an option to do that. So with the standard rate, and again, only for home family child care providers, you do keep track of the meal types and the numbers, but they're multiplied by a set amount, and that set amount is based on tier 1 of the CACFP. So when you look at tier 1, with the standard rate, the pros are that there's easier record keeping, right? You can, and you have the tier 1 rate, but you still also can deduct non-reimbursed meals and snacks. So you still have the ability to do that if something isn't covered under the CACFP. What's a con to that? You still need to keep the name of each eligible child, the dates and hours of attendance, the number and types of meals served. So keep that in mind there. So you can use, and you will use, if you choose the standard rate, you will use that tier 1 rate for the CACFP, regardless of whether or not you participate in the program. So you do not have to participate in the CACFP in order to use that tier 1 standard rate expense. So with the tier 1, with the standard rate, it is a little different than what a normal CACFP allowance would be. So with the standard rate, you are able to use that tier 1 rate to basically claim a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks. That's different than if you were filing under the actual food program itself. Those allowances are either 2 meals and a snack or 2 snacks and a meal. So I believe we have a link in there for the CACFP reimbursement, should be in the chat as well. So when it comes to food, we either have the actual expense, which is all that child care centers can take, or we have the standard rate, and a home-based provider has their choice between the standard rate and the actual expense method. So keep that in mind there. All right, now this is the one that also affects all family child care home providers. And what you need to do, right, is home is a tricky topic because you need to figure out how much of your expenses are considered business expenses and what percentage of those expenses can be deducted on your federal income tax. To do this, child family care providers use the time-space calculation. So in time-space, we look at space as one of 2 different things, right? So it's either regular use space or exclusive use space. So let's look at the definitions of those 2. What is a regular use space? It's an area that's used all day, such as a play area, could be a part of the day as napping, but would also have other uses during non-business hours, right? So that's shared with your family use of home, with your own use of your home. Those are spaces that after the child care day is completed, that space is used for something else or used for your family throughout the day. That is considered to be a regular use expense, and that's important when we start to talk about time space. The other part of time space is exclusive use, and those are spaces that are only used for your child care program and nothing else. So only for child care. We've got exclusive use, we've got regular use. Let's stop and take a look at a couple examples. All right, so what is an example of exclusive use? Well, that would be if you have a separate basement entrance only used by the families of your child care business. Maybe you have a storage room that's only used for toys and supplies for your business. That is exclusive use, a space that's only used for the business. Now, regular use could be if you're using your family's bedrooms for nap time, An example would be if you use your living room once or twice a week for a certain activity, for let's say a STEM activity. In those instances, that is considered to be regular use space. So when we think about expenses that are related to exclusive use space, those are fully deductible. It's actually based on the amount of square footage of your home. It's 100% of a business expense. There's no family use involved. That means 100% of that expense is allowable. Now, regular space, right? That's based on the percentage of time that's used for a business. So what we want to do is make sure that we document both regular use and exclusive use space, because you do need to be able to justify your home deductions. So you need to be keeping records, doing the measurements correctly, and we'll talk about that. All right, so we know that the home costs, right, based on that exclusive use or regular use, they can be either fully or partially deductible. Now, what will happen is that an exclusive use, as we said, fully deductible. I like to give some examples for these. So if you're replacing tile in a basement that's only used for childcare, if you're installing a child-sized toilet, or liability insurance for your business, those are fully deductible, right? Those are 100% deductible expenses. So in keeping that in mind, those are business costs that are either exclusive use or are 100% allotted with your business. Now, expenses for regular use spaces or common improvements. So if we are using if we have an expense that involves a regularly used space, or we have an improvement that is involving business and family use of the home, if an expense covers that portion of our home that's used for both, that is something where we're only going to be taking a percentage of the expense. So an example of that, right, would be if you're replacing all your home windows, well, you're not going to be claiming 100% of that expense, because those home windows are used, yes, by your childcare, but also by your family, right? So that's something that time space is going to come into impact. If you repaved your driveway that family members use to drop the children off, pick them up, that driveway is also shared use with your family. Therefore, that's something that we're going to be having to use a percentage for that calculation there. Another common expense is homeowners insurance. So homeowners insurance, again, shared, business, personal, shared, that would be something that you would only be taking a percentage of, right? So in a regular use space, you use time space calculation to determine how much can be deducted. So that's how we determine how much of our expense we can deduct. We've talked about the time space calculation, and we're going to go into it in depth in a moment, because a lot of people, there's some confusion surrounding it. But when we get into time space calculation, remember the key is identifying whether a cost directly supports and 100% is allotted to the business, or is there something that has to do with a shared space? Is it, or, a general home improvement, to determine, is it a fully deductible expense, partially deductible, or even a non-deductible expense, right? Something that we do for our family home that has nothing to do with the business, we would not be claiming that as an expense. All right, so the first thing we put on our thinking caps when it comes to time space, right, is regular use and exclusive use. So there's the two types, two elements, right? We talk about time and we talk about space. So the time portion of the time space calculation weighs how much time regular areas are used for business, right? So regular use areas, shared areas are used. Keep in mind, right, if we think about time and then we think about an exclusive use space, well, that's used 100% for the business. So there's actually, for exclusive use space, there isn't a time element that's taken into consideration, because that expense is incurred throughout time, right? Because it's only having to do with business there. There's no other use for those spaces other than business. So, but a regularly used space, we have to think about the portion of time that you use that for your business. Now, what's nice about the time space calculation is you can break it into 6 very easy steps. First thing you're always going to do is you're going to determine the square footage of your regular use space. And that's going to be measuring the width and the length of every space that is used combined for family use and the childcare business. All right. So you're going to take that, you're going to add all of that regular use together, and you're going to divide that number by the total home square footage that you have. So if your home, and we'll show, they've got a great example, but if your home was 1,500 square feet, you know that that's the number that you're going to divide into the amount of space that you've measured and add it up for your regular use space, right? So we have that. Then the next thing we need to do, we've looked at our regular use, we've determined the amount of space. Now we need to determine the amount of time. Okay, so how much time is your home used for childcare? So what you do is you add up all of the hours in a year that your home is used for childcare, and then you're going to divide that by the number of hours in a year, which is 8,760. That gives me a percentage. So I got a percentage when I did my space calculation with my square footage, and now I've got a percentage when I do my time calculation. What you do is you multiply the time percentage that you got and the space percentage that you calculated, you multiply those two together. We're going to put that to the side for a second. We'll think about that in just a second. Next, what we're going to do is we're going to measure all of the exclusive space, right? So the space that's only used for the child care. Once I add all of that up, we're going to divide it again by the square footage, entire square footage of the home. So you add the percentages that you came up with in step 5, right? When you multiply the time percentage and the space percentage, you take that percent, you add the exclusive space percentage to that, and that gives you your time space calculation. So at the end of the day, 6 easy steps, right? So using those steps, you can easily determine what percentage of your expenses can be deducted from your federal income tax. That's how you go about calculating the amount of expenses that are shared. And you get to include the exclusive use space in the time space calculation that you use for expenses that are not 100% handled for your business. All right, so we're going to just give a quick example, and then I'm going to walk through those 6 steps and we'll take a look. So this example, basically, what do we have here? Well, the business has a home. The home entirely is 1,500 square feet. 500 square feet of that are used exclusively, right? So there's 500 square feet of that space that we only use for our childcare. Let's put that number to the side. We did all of our measurements of our regularly used space, right? So the space that's shared between the home and business use. That in our example was 700 square feet. Now, this provider is open 10 hours a day, and they spend 1 hour before for cleaning, for prep, and let's say 1 hour after for cleanup. And she's closed 2 weeks, excuse me, 2 weeks during the year for vacation. All right, so we take all of that, and now we're going to apply it to those 6 steps. All right, so how are we going to determine the square footage of the regular use space? All right, so we know the total of the home is 1,500 square feet. How did we come up with the 700 square feet of regular use space? Well, we multiplied the width times the length of each space. That gave us the square footage of that space. We added all that square footage together for regular space. So keep in mind that you may have some oddly shaped spaces, right? So maybe you've got a little nook, maybe you've got a closet. Basically there's something that's a little odd. It's not just a rectangle or a square. What you're going to do is break that out. So break those spaces into blocks. Let's just address the closet. Let's address the rest of the room there. And then you measure the square footage of each one of those little odd spaces, and everything comes together, and you add everything together. So you should be measuring closet space. You should be measuring those little nooks. It's just that you're going to take them as their own little blocks, figure out the square footage for that space, and add it to the square footage perhaps of the larger rooms there. All right, so now I figured out the square footage of my regular space. Now what I have to do is divide that number by the square footage of my entire home. So we know in our example before, we had 700 square feet of regular space. I'm going to divide that by the 1,500 square feet of my home. What does that give us? We're going to round up in this instance, but it gives us 46.7%. So we're rounding up. Now, I want you to keep in mind that square footage of outdoor areas cannot be included in time space. Now, an external space that's attached to the home, that's regularly used for childcare. So let's say we care for children on the deck, they play on the deck, that's attached to my home, that can be included in the time space calculation. So you could measure that space for regular space, but it has to be attached to the home, obviously use a portion of that time for your childcare business there. So we're not measuring the yard. All right, let's keep that, just kind of keep that in mind there. All right, great. We figured out the space for regular use. Let's determine the time for regular use. So how many hours is the childcare open per week, including the time spent preparing and cleaning up when the children are when they're not there, right? We are able to include that number there. So we look at how many hours a day we're open. We basically then take a look at the number of days in a year, the number of weeks in the year that we're open. So in our example here, we were open 3,000 hours in a year. We take that 3,000 hours and we're going to divide it by the total number of hours in a year, which never changes, right? 8,760. So when I divide that 3,000 hours that I'm open and do the prep and the cleanup, after vacation, after I take out those 2 weeks vacation, that works out to be 34.2%. All right, so we know that my space percentage was 46.7. My time percentage is 34.2. I'm going to multiply those two together, right? So 46.7 multiplied by 34.2, we're going to round up to 16%. So there is the time space calculation for the regular use space. But now what are we going to do? We need to get the exclusive use space, that percentage. So in this instance, we had 500 square feet of regular use space. Now we're going to divide that exclusive use space. We're going to take that 500 exclusive use space square feet, divide it by the 1,500 for the whole of the home. That gave me 33.3% of exclusive use. I take 33.3, I add to it the 16% that I got for the time space use for regular use space. That gives me a time space percentage of 49.3%. That's what I'm going to use for any expense that I have that's a shared use between home and business. So that's how you come up with the time space calculation. Without a doubt, it's not difficult. You shouldn't be intimidated by it. The other thing I'd like to bring up about time space is that if you have had somebody else preparing your taxes, at times they don't know the accurate time space percentage, and perhaps they're just claiming a rough number. They ask you how many square feet you have in your home, and a lot of times they turn around and say, oh, 50% of that is used for your childcare business. That's not an accurate measurement. And the odd thing about the IRS is they could come in and actually measure the space of your home, a little quirky, right? The whole business use of home is actually something that's exclusive in the tax law to home childcare providers. So you don't find other businesses that have that. So this is something that's special to us, it's special to our world. Keeping this in mind, it's not difficult to do. And what you may want to do is if your home time space calculation was created by a tax preparer, perhaps way in the past, maybe it's time to remeasure things. And sometimes stuff changes. Maybe you have more exclusive use. Exclusive use drives that percentage, drives up the overall time space percentage, works more to your advantage. Couldn't hurt if you haven't done it in a while to go through and take a look at remeasure that space. Take a look there. So, all right. The other tricky topic that we have here is stimulus funding. And we do know that stimulus funding, we had quite a bit of it, right, in terms of the stabilization grants, and some states had different their own funding in addition to perhaps this, in addition to stabilization, or that money came from stabilization, but the grant was created just a little differently there. So what you want to keep in mind is that stimulus money has to be reported as revenue. It is taxable. But what you have to keep in mind, however, is that any valid business expense that you had associated with that money, so anything that you used, allowable expense that you used that stimulus money for, that is expensable in the same year in which that expense is incurred, right? So we're going to take a look at 3 different scenarios. How could our taxes be impacted with stimulus money? And keep this in your mind, right? Because we did receive, most of us received stimulus money in 2023. So this is something to kind of take a look at. Now, this first example is super straightforward and is actually what we all hope for, okay? So in this particular example, the business received $10,000 in stabilization money. That's reported as revenue, right? We know we have to do that, but they spent it on $10,000 of expenses, and here's the key, in the same year. So the year that I received the revenue, I also had the expenses, right? So I'm claiming the revenue, taking all the expenses. What is my taxable income for the year? 0. Taxable income is 0. But let's look at our next scenario, excuse me. And in this instance, I received $10,000 in grant money in revenue, but that year I only had $5,000 in expenses. Well, what does that mean? I've got an additional, now I have taxable income of $5,000, right? Because I didn't have the full $10,000 to put towards the, counteract the revenue. I only had $5,000 worth of expenses in the year which I received $10,000 in funding. That means I'm going to be taxed on $5,000. Now, the last example does happen, and you want to be very really thinking about this, because we do know with our stabilization grants, we were able to use expenses in the past, right? Our stabilization grants basically originated due to pandemic-related circumstances. And what we want to keep in mind is that there were times, perhaps, when we received in 2023, where we received stimulus funds, but because we're allowed to use them on expenses that happened in the past, we can't deduct those expenses again. We took them off of that last year's taxes. So in this third scenario, what we see is that we took in $10,000 in revenue, but all the expenses that were associated with that $10,000 in revenue were from a previous year, right? Either 2022 or 2021, depending on how the stimulus money was working for you. In that instance, your taxable income is $10,000. So you're going to have to pay taxes on all $10,000. So those 3 scenarios are something to keep in mind when you think about stimulus funds. All right, so here's something, right? Once the year is closed, we always think, oh, December 31st, any expenses that we incurred from January 1st of that year to December 31st, that's going on the 2023 taxes. Is there anything that I can do to lower my taxes, even though now it's February? What is there? There can't be anything, right? That's what we think. But does it mean you have no option? Actually, this is something that is really, really advantageous that a lot of business owners don't put into play. Okay, so basically, if you're looking for a way to mitigate your taxes from 2023, what you do is you have this one option, and that's contributing to a retirement plan. So if you don't already have a retirement plan for your business, when you set it up, it can have tax advantages. So contributions that are made to a retirement plan on behalf of the business owner and employees are typically tax deductible. Well, under an IRS rule, you can open up until April 15th, you can open a retirement plan, contribute to that retirement plan, and still have it reduce your taxable revenue from 2023. So this is the one time that we can actually, oops, the year is over, right? We're not going to be able to find any new, we found every expense that we have. Oh, wait a second. I can start and contribute to a retirement plan, make that investment in my future, and lower my tax liability in 2023. So what a win-win. That amount that is put through a business retirement account through the business into, in this instance, we're showing an SEP IRA, okay? So basically any expenses that you, any contributions that are made up until April 15th would help you reduce your previous year taxes and give you retirement funds. And a lot of people don't think about this. A lot of business owners don't think about it. It's a great way if you didn't have as many expenses as you thought you were going to have in 2023. Here's something that's a fantastic way to approach it. You'll want to discuss the option with a financial institution that works with retirement plans. There are others other than the SEP IRA. We just happen to bring up the SEP IRA because it's the easiest for small businesses to set up. It's the most common. There are others, and when you meet with a financial institution, you can talk about all of your different retirement options that you can actually now take advantage of in these first few months in tax season of 2024. And reduce our tax liability in 2023. So that's something that's really exciting. Put your head together with a financial institution, come up with a plan for that. You still have time. We're only into the second week of December, right? So this is December of February, excuse me. Know where my head is at. All right, so okay, so let's face it, the only option that we have in terms of mitigating our taxes now was that retirement option. But what should we do if we have higher taxable profit than we expected? It's a great thing, but you're thinking, well, I really would have liked to have reduced that tax, the tax responsibility, right? I would have liked to have lowered that. Well, in this instance, right, we can't, other than the retirement plan, we can't reduce that, but it's the perfect time to use your money wisely. So when we've had more higher taxable profit than we expected, there are some actions that you might want to take that benefit your business overall. Or maybe doesn't lower your tax liability, but these are really good business decisions to make, right? So the first would be paying down debt. So if you have extra money that you hadn't anticipated, great opportunity to pay them down. Does it lower in this now being in 2024? Does it lower the 2023 tax liability? No, it does not. But it can save you money in the long run, right? Because now we're no longer paying interest. We're knocking down that debt. What a great feeling when that happens and you reduce your debt. Another wonderful way to use that money would be to create a reserve fund, right? So a financial cushion. Every business needs a financial cushion. So if you have higher profits, steady expenses, you know what those expenses are going to be, the profits are perhaps more than you thought, or as you went through the year and you investigated your business's health, turns out you're having a really healthy year there. How about setting aside some of those profits to cover future expenses, unexpected costs? When you look at a cash flow and you look at from month to month, and there are months where perhaps we don't have the cash flow that we had in previous months, it would be great if we had a reserve fund to help offset some of that difference. So reserve fund, again, lowering my taxable income in 2023. Nope. Great business practice. Yes. So we want to do that. Another thing you'll see here, right? We talked about investing in business expansion. So you've got higher profits. Why not invest in the growth of your business? So you could be hiring more staff, physically expanding the premises. You could be investing in marketing and advertising, right? So those could, first of all, lead to higher revenue in the future. Great investment in terms of the business, right? Also keep in mind that those expenses are going to be tax deductible in 2024. So while I didn't lower my 2023 tax liability, I did something to increase the value of my business, to grow my business, and now I can take those as expenses in 2024. So there is benefit there. And the other thing that at this time of the year that you would want to think about that you can do right now is set a time for your mid-year tax review. So let's think about everything that we've learned, how we can benefit in 2024. So many business owners do a tax check-in somewhere between August and October. And even though it's late summer, early fall, it's usually referred to within the tax world as the mid-year tax review. So it's important because as it lets you see what your tax liability is going to be at the end of the year. So think about it in terms of paying your estimated taxes. When you do a mid-year tax review, you can actually figure out what those final tax payments, estimate what those final tax payments are going to be, and you can plan, right? So that's fantastic. So there you're looking at your tax liability, because we know with all of our estimated taxes, you have to pay, it's the law that you have to pay at least 90% of your actual taxes for a current year, or 100% of last year's taxes, to avoid a penalty. And that's why you do estimated taxes, right? Because it's against the law to have this huge tax liability. It's in terms of business. That's why you have to make those tax payments, right? So those estimated taxes. So if you did a tax review before the end of the year, you would have a really good idea what the last payment is going to be for estimated taxes. And it can help you plan. It can help you avoid penalties. So really, really good idea. How do you do it? You're going to check all your revenue that you took in for that year to date. You're going to look at the expenses year to date. We're going to look at that profit. We're going to look at how much we've paid in taxes so far. And you can go really, really in depth, or you can just do that. You can just look at the revenue, project what you believe the revenue is going to be. How much in taxes, estimated taxes, have I paid so far? Okay, based on what I think my revenue is going to be, what's the difference? How much more tax am I going to have to pay in estimated taxes, let's say in the fourth quarter? Now I'm in the middle of the summer now, or mid to late summer. What do I need to put aside for quarter four? That's what a mid-year tax review can do for you. So really something that's great that you can do right now is to plan for when you're going to do that, right? And get into that mindset that somewhere between August and October is a great way to kind of help wrap up my tax liability next year, basically, looking at my estimated taxes. So, all right. Now, as we mentioned earlier, when you review all of your numbers, you might find that the taxes aren't your issue, right? So we talked about you could have a profit or you could have a loss. But if this time of year you're on track to make less money than last year or lose money, now's the time to take a deep breath. Okay, let's think about this. We're going to want to review and reduce expenses in this year, right? We had this year where we made less money than we wanted to, or we didn't make any money. What am I going to do right now? I'm going to review and reduce my expenses. So we're going to look at those expenses in detail, identify any area where a cost could be reduced, as long as it doesn't impact the quality of your service, right? So we want to make sure that we're still maintaining those high levels of service that we always have. Maybe we find more cost-effective goods or services. Maybe we reduce unnecessary overhead cost. We find a way to utilize resources more effectively. Let's look at those expenses. The next thing we want to do is, collecting the money that's due you is important. So if you have slow paying families, consider improving your billing and your collections process. It can help your cash flow, right? Reduce the need to borrow to cover expenses, really help you with your business health. So think about that. The next option, we take with some caution. There is, of course, always the possibility of exploring financing options. And, if you had a temporary cash flow problem, maybe you would think about a short-term business loan or a line of credit, but you have to be so very cautious. It leads to additional financial obligations. It's there as a possibility, but that's not our go-to, right? We don't want to think about that. Next thing we want to do is, if costs have risen and we basically are reflecting less of a profit than we had expected, what are we doing now? And 2023 wasn't exactly what we wanted. Maybe it's time to evaluate our pricing, right? So evaluate your pricing strategy. Costs are continually going up. It might be necessary to increase your prices. All right, you have to take careful consideration, right? You don't want to impact your customer retention. You don't want to reduce that sales volume. You want to make sure that you're maintaining and growing your business, but it might be time to look at pricing strategy on there. And then, if you happen to see this happen more than once, or you're starting to feel like you're in a position where you're not going to be able to pull yourself out by reducing expenses, improving your collections, and evaluating your pricing, seek professional guidance. Don't let it go too long. All right. So if you're struggling with lower revenue, if you've got higher expenses than you want, look for an experienced, licensed financial advisor, business consultant. They can help you provide a fresh perspective. They can look at things in a way that you haven't. They can basically suggest strategies for improving financial stability. So please, by all means, keep that in mind. You don't want that cycle to continue. All right. Now we've done all of this. We're coming up on April 15th. How can I get my taxes prepared, right? How are we going to do this? Well, we have a couple options. All right. So small pros and cons list here. So let's compare paid tax preparers to self-preparation, right? And decide what method works best for you. So if I have a paid tax preparer, I'm going to look for somebody who's been recommended by people in my network because childcare businesses are unique. And we are looking for someone who has childcare specific experience, all right? Whenever possible. And speaking to folks within your community, within the childcare community, is a great way to do that. So what's nice when you have a paid preparer? Well, you have a guide all along the way. Fantastic. Oh, it could be expensive. All right. It could be expensive. But what's nice is that you've got the guide and they may be able to provide advice. So you have some support that you wouldn't have if you were preparing your taxes yourself. Now, self-preparation of taxes is usually more cost-effective, and it's very efficient for providers because there are so many different types of software that can help you. So an interesting thing is that the IRS is actually less likely to audit online or computer-generated tax returns than they are things that are done by a preparer that are not using some type of online or tax preparing software. They're actually considered to be more accurate. It's very beneficial to use something like that. So calculations can be more accurate. It's definitely less expensive. There are some costs that you may not realize that are involved when you use tax preparation software, and that's if you needed additional support. Having someone guide you along the way is an extra cost. Okay, so we look at those two: paid preparers, self-preparation. Whether you decide to take if you do decide to take everything to a tax preparer, all right, keep in mind that you want to keep systems to make sure that you're tracking your income, tracking your expenses, tracking your deductions, and being very aware of it. You don't want to just hand over things to a tax preparer. You want to go there with the understanding that you are the most knowledgeable person about your business, and you have a really strong leg to stand on in the fact that you know what's happening in your business. You've already done all of that preparation. So if you are going to a paid preparer, you're going to want to have that type of knowledge. All right, so if you are going to look for a paid preparer, there are a couple questions that you can ask. So are they qualified? They need to have an IRS preparer tax identification number, which is a PTIN. So look for a PTIN. Basically, paid tax preparers are required to register with the IRS. So ask for that in advance. They should be sharing that with you. If they don't have that, they should not and are not allowed to be preparing your taxes. So there's an IRS directory. If you just go to the IRS website, you can actually look for a preparer to make sure that they have a PTIN, make sure that their credentials are up to date. So, okay, so we want to make sure that they're qualified that way. Did they receive training? So you want to know if your tax preparer has professional credentials, right? So there are enrolled agents. Those are tax preparers that are licensed by the IRS, certified public accountants, attorneys, all of them. There are many that work as tax preparers. You will also find tax preparers that are participating in the annual filing season program. There are bookkeepers, certified financial planners. Basically, there is also a directory on the IRS website of federal tax return preparers in your area that you can search for by zip code. Just keep in mind, right, we talked about our next step is, have they worked with childcare businesses? So just because there's a list on the IRS website might not mean that those people are appropriate for our business. So we want to think about, have they worked with childcare businesses before? Experience counts, okay? So when looking for qualified tax preparation service, experience counts. You want to make sure that in addition to checking for their length of experience, Are they knowledgeable about the business? Do they understand the childcare business? Do they realize the specific circumstances? If you ever went to a tax preparer and said, well, my time space calculation, and all of a sudden their eyes glaze over, that would not be the person that we would want to help prepare our home-based childcare provider taxes. So you want to ask if your tax preparer is part of professional organizations, if they take education, any type of educational classes. Are they familiar with the industry? I shouldn't say industry. Are they familiar with the childcare world? And do they know all of also your state and local tax requirements, not just federal? So another important thing is, are they available after tax season for advice or changes? Sometimes we have to amend our taxes. Sometimes something comes up and we would like to have some support outside of the tax season. Are they available? And then perhaps the most crucial is, can you get, well, they're all crucial, but make sure you get a copy of your return, okay? You need a hard copy of the return that was filed. You need all of the documents that were included in your filing. So if you handed over receipts, you need to get all of those back, okay? They belong to you. So you obviously always want to have a copy of your tax return for your records. You never know if you're going to need it quickly. There are online tax systems that you can get copies. If you prepared your taxes online, you can get your copies back really, really fast. You can also get them from your tax preparer. They should, at the end of the time that they've spent putting together your taxes and notifying you of your tax liability, they should be then giving everything back to you, okay? A good idea then would be to take those physical copies, scan them, keep electronic copy, keep your paper copies, all right? So you basically could take those scans, put them on a backup hard drive, a hard drive that you back up. You could, put them into some place that's secure and keep copies of keep the paper copies as well. So, and just make sure when they give you back the receipts that it's receipts, proof of payment, all the 1099, any tax document, because you're going to want to hold on to those for at least 4 years. All right, now, if you want to complete your own taxes, there are a lot of online guides that can help you. All right, so there are guides that have been specifically designed to work with childcare providers if they want to use online tax software. So there's guides for TurboTax, H&R Block, Tax Act. You'll see we also have a buyer's guide. There are some links here. Jill, I'm sorry to call you out. Do we know if these links that are on the screen were those two that we had an issue with?
I don't believe
Okay.
so. In fact, I think Carlos has put the updated links
Perfect.
into, so yes, so you
Great,
should be
thanks.
set.
Thanks. I just wanted to make sure, Jill, before I went any further. Thank you. So Carlos has made sure that all of the links that are in the chat are accurate. So there is a link you'll see in the chat, for the TurboTax self-employed this is a mouthful, the TurboTax self-employed online tax preparation guide for childcare businesses. So if you want to use TurboTax, here's something that is really involving childcare businesses. Fantastic. There's the other link that you see here are all the guides that basically help you understand the stimulus funds and taxes, managing business finances, business operations. These tools are free. They're easy to use. They do have elements to them that help with the Schedule C. They have screenshots that help you. By all means, please take those links that are in the chat. Go to those tools. They really, they're free and they work really, really well. So, all right. Now here's another lengthy. So the Confidence and Quality Tax Rubric app was developed with actual real life family and center childcare providers looking at their tax returns, and then basically helping preparers understand tax regulations for childcare. So the rubric really came into play. It's helped actual childcare tax providers, it helps childcare providers. Okay, so the rubric is designed for sole proprietors and single member LLCs. So just keep that in mind. Basically, if you report your income and expenses on a Schedule C of your 1040, this will help you. If you are a corporation, S Corp, C Corp, partnership, or an LLC that declares themselves, files taxes as an S Corp or a C Corp, there's still benefits to using the app, but the expense lines are different. They don't line up. This app, the expenses line up with the Schedule C, but there's still a lot there. So this link is in the chat. It's in the chat as the Civitas rubric app. It's available in both English and Spanish. By all means, it's something that really, really works very well. We also have in the chat, I should say, excuse me, there's what's called proactive tax planning tool. Very, very helpful prior to year's end. So maybe we're not using that right now, but we are going to use it later in 2024. So you'll see that there. It's included on our CivStrat website. So it's at www.civstrat.com/proactive tax planning. That link is in the chat as well. So that's something that think about, keeping that in mind, that you're going to use towards the end of 2024. Proactive tax planning, let's use it not at the end, but let's use it throughout 2024, let's say. But right now you're not thinking about your 2024 taxes, even though you want to think about your taxes all year long. So we have that there. And that, I didn't even look at the time. We're running over, aren't we? I apologize. I can talk like no one's business. All right, so now as we draw to a close, it's important to reflect on all of the insights that we discussed tonight, right? Accurately reporting your revenue, accurately reporting your deductions, now you're going to collect all that financial data through the year. You're going to connect with either a qualified tax preparer, or you're going to connect with, you're going to figure out some tax software and learn about that. So just keep in mind, right, we had those tools that we showed you, the homegrown tool, the tax rubric, so many different tools that can help you with your taxes that really are made for childcare providers. So everything that we went over today is meant for education. You would want to, if you have any questions that we can't answer here tonight, you're going to want to work with a qualified tax preparer. This is not meant to be in place of legal or accounting advice, but it is meant to be educational. So maybe our friends Jill can help me. Jill, do we have any questions in the chat?
Hey, Jen, thanks for
Hey.
sharing lots of valuable information.
Oh, you're welcome.
Carlos re-shared those links that you
Thank
had
you.
in there. I'm looking at the questions. Let's see. We did have one that I answered in chat too, but it asked about the standard deduction for meals. Do they include water and things to drink, or just meals? And so, yes, when you're claiming your meals, that includes beverages and the food that you serve. So that's something to note. And then Amy asks if we can rewatch. Yes, Amy, we are recording the session, and then we will share the session with our LISC partners, who will then share with you as well. So that is an option as well.
Have any other questions, Jill?
Let's see. How much of food expenses can be used?
Well, we have the two methods. So I'd be curious if this is a family child care provider or a center, right? So you have the actual, basically food, unless it is for your employees or your own children, food is 100% of an allowable expense, right? But you just have to decide which of the two methods you're going to use if you're a family home provider. If you are a center, you can only use the actual method and basically record every single food expense. But if you're a family home provider, you could also use the CACFP Tier 1 rate and use that, allowing again 3 meals and 2 snacks per day using the Tier 1 rate. So, but all food costs as long as they do not involve your employees, which only receive 50% of a deduction. Your children, you cannot claim that at all, but otherwise all food expense, all drink expenses are allowable.
All right, I think that's our last question, Jen. Thanks
All right.
everyone for staying with us.
I'm just advancing here. Just this is us saying thanks, and you will see Tom Copeland's. We are very fortunate to be the stewards of Tom Copeland's blog, so we have the link in the chat as well. Please visit us on Facebook and LinkedIn. And we would just like to explain that we have a YouTube channel that has over 600 videos, and this is the QR code for that. By all means, if you don't use the QR code tonight, just search Civitas Strategies on YouTube and you'll find our channel. Monthly budget, handbooks, taxes, retirement, videos in English and Spanish, Ask the Expert videos. Our YouTube channel is really, really helpful. And just so that our Spanish speaking providers who are here with us this evening, just so they can see, here is the slide. It's the same QR code.
All right, thanks everyone and
Right.
good night.
Well, that is it, folks. I apologize. Oops, ran a little over. Jill's going to be mad at me. There we go. So, but thank you all, for anyone who's hung in there with us. I want to thank, and of course, I want to thank LISC for having us here this evening. Thanks, everybody. Have a great night.